If you're a contractor, you've probably been told, just become an S-Corp. You'll save a ton on taxes. Sometimes that's true. Sometimes it's dangerous advice. Today, we're breaking down how the IRS actually taxes LLCs and S-Corps so you don't accidentally volunteer to overpay or get audited. This is planning, not hype. IRS rules matter and one size fits all does not exist. I'm going to actually go through 2 different tax returns with you so you can see the true difference between an LLC or sole proprietor and an S-Corp. That's on today's Savvy or Surrender podcast. I'm your host, Stephen Young, and today I've been seeing a lot of misinformation out there with S-Corps, or just simply a lot of videos about S-Corps, and maybe some of it is right and some of it's wrong, but it's pretty general advice. So I wanted to actually break down for you the difference between an LLC or a sole proprietor and an S-Corp so that you can actually see on a tax return itself. Right here, we've got a tax return. If you're looking at YouTube, I'm going to show you the tax return itself. We are going to get into it. I know that doesn't sound like a lot of fun, but I want you to see where the differences actually are and why an S-Corp might make sense for you. All right. Hey, if you like this podcast, Savvy or Surrender, I would greatly appreciate it. If you subscribed, liked this video, leave us a comment. I would love it. If you're checking us out on Apple or iTunes or podcasts, or if you're looking at Spotify or wherever you get your podcast, please hit subscribe, leave us a review. You can also email us at podcast@savvytaxstrategies.com. Okay, so let's get into it. And the first thing I want to do is clarify the difference between an LLC and an S-Corp. So an LLC is really just a legal structure. It's completely separate from tax structure. So legally, we have an LLC or legal liability company. And the idea behind it is that you're separate from your company in the event of a lawsuit. Now, I'm going to stay in my lane. I'll let the lawyers talk about what they can do with an LLC, but I'll just say that, the idea is that you're separate between your business and you as a person. Now, most likely though, you are not doing all of the things necessary to protect yourself. They being a lawyer will, worth their salt, they'll find ways to pierce the veil to be able to get through the LLC and get to you personally, because you're probably not doing all of the things you need to do to maintain that separation. So that's a whole different conversation that I'm not going to get into because I'm not the lawyer side. Tax-wise, an LLC is literally called a disregarded entity with the IRS. They don't care that you're an LLC. You're taxed. This is a single member LLC specifically. You're taxed just like a sole proprietor. It's on your 1040 on your personal tax return. No difference whatsoever. Now, if you're a multi-member LLC, meaning you have more than one person, then you're taxed as a partnership, or you at least not taxed, but you have to do a partnership tax return. It's an informational return. You do the tax return, and then it goes to your personal, your 1040. You get a K-1 on a partnership, very similar to like an S-Corp. Okay, so if let's just say you're a single member LLC right now, and you get taxed on your personal tax return. If you want to go to an S-Corp because you hear about all of this tax savings that might exist, then what you do is you stay an LLC and you become taxed as an S-Corp. So you would say technically you're an LLC taxed as an S-Corp. There is no S-Corp filing designation with like the Secretary of State. You won't see that out there. It's you become an LLC with the state, and that's your entity structure, your legal structure. And then you go to the IRS, you file what's called Form 2553, Form 2553. It's 4 pages long. Pages 1 and 2 really have all the meat of it. For the majority of people, you're only going to fill out those 2 pages. Sign it on the bottom of page 1, and then in the middle of page 2, there's another column you got to sign there too, so make sure you got 2 signatures. You want to fax it or email, or not email. They won't take email, but you can fax it because the IRS still has faxes, or you can mail it to them and wait a while, and then they'll get you they'll send you a letter that says you've been approved to be an S-Corp. And now you're being taxed as an S-Corp. So you can either elect, so that's how you send it off and where you send it to them or how you send it to them. Most contractors don't choose the wrong entity. They just never realize that they made a choice at all. And what does that mean? It means that a lot of times you file an LLC paperwork and you're thinking, okay, I'm doing this, the right way. You've got my business taxes set up now. It's the same thing. It's still personal. Now let's get into really what the differences are though, and how contractors are taxed by default as an LLC sole prop partnership. Your net profit is your self-employment income. So if you have a business, if you're an LLC, you're a sole proprietor, whatever your net profit is, you get taxed on that as self-employment income, meaning the whole thing is subject to income tax, your federal and state withholding. If you have a state that withholds tax, you've got those. Then you also have your self-employment tax. The entire amount of profit gets taxed at 15.3%. That's Social Security and Medicare. That gets reported on Schedule C. So you're going to have your regular business tax return, and then you're going to have a Schedule C, and then you'll also have a Schedule SE, which stands for self-employment. That's where that 15.3% hits. When we do our case study here in a little bit, you're going to see that form on there and where it applies. Now, one of the big things that we need to figure out too is there's this thing called QBI, or Qualified Business Income. And that gives you a 20% deduction to hopefully reduce your income tax. It depends on what type of business you are. There's a few businesses like accountants, lawyers, that don't get to use that 20%, that QBI deduction. I don't know why. They just decided we don't get to qualify. But if you're a contractor like who I'm trying to talk to right now, you get a 20% deduction on the income portion, not whatever is wages. So we'll look at that with an S-Corp, where that kind of affects us and where we get a little bit less deduction on the QBI. Okay, here's how an S-Corp changes the tax game. Now, when you become an S-Corp, you're, as an owner of the business, you are now an employee. So before you had $100,000 and all $100,000 was taxed for self-employment, 15.3%. So if let's say you made $100,000, that's $15,300 that went towards Social Security and Medicare. Now, as an S-Corp, you're going to see these split up. You've got the owner portion, or when you become an employee, you've got the reasonable salary, the W-2 wages that you have to pay the Social Security and Medicare on that part. You as the employee pay 7.65%, and then the business pays 7.65%. So technically still you're paying 15.3% because you are the business, right? So you're paying 15.3% on that pay. And then you have the payroll taxes, right? Applies to wages. The remaining profit is considered a distribution and not subject to self-employment tax. So if you take that same $100,000 example, $50,000, let's just say we go with $50,000 for payroll, and we'll talk about what a reasonable compensation is here in a second. But let's just say it's 50 grand to make it easy. 50 grand times 15.3%, so that's about $7,500. That's going to be applied towards your Social Security and Medicare. And then let's say you take the other $50,000 as a distribution. You no longer have to pay the self-employment tax. You still have to pay the withholding tax. So whatever your federal effective tax rate is, you're still paying that. So it's not like it wipes out taxes altogether. It just wipes out that Social Security and Medicare tax. And if you have a state tax, you're still going to have to pay it on that as well. So a lot of times people will misunderstand that. You still have to pay the withholding tax. Now, let's get into reasonable compensation. This is where a lot of contractors will screw this up. Here's the challenge. The IRS expects you to pay yourself a reasonable wage. You're a corporate officer. You're also, you're the owner of the business, right? What would it take to replace you? Paying yourself $20,000 to dodge a payroll tax is really the same thing as saying, hey, Mr. IRS, I want to be audited. You have to have a reasonable wage. But now, here's the trick. The IRS doesn't define what a reasonable wage is. You get to define it. So you just have to actually define it though. If you just say, hey, I want to do 36,000 or hey, I want to do 50,000, that may be reasonable. It may not. It depends on your role. It depends on how much time you're spending. Maybe this is just one business that you have, and so you're only spending 20 hours a week. Well, then maybe $20,000 is okay. But if you're spending full 40 hours a week on it, $20,000 probably isn't going to be enough money. It's probably not going to cut it. It also depends on your skill and what the market will bear, what the market wages are. You can't pay yourself the federal minimum wage of $7.50 an hour or something like that. Obviously, that's not going to work. So you have to look at what the market wages are: skill, time, role. What are you doing? So a good way to break this down is if you work a 40-hour work week. Now, I realize most business owners, you probably work more than 40 hours, but let's say you work a 40-hour work week. And let's say 20 hours of that is spent doing what you actually do. You're an actual landscaper. You're an actual plumber. And then the other 20 hours of the week, you're spending doing admin stuff and marketing, and you're going to networking meetings, things that a $20 an hour person can do. Well, then factor that into figuring out what your wage comes out to and use that. An S-Corp doesn't mean you stop paying taxes, and it means the IRS is going to watch how you pay yourself. Now, there is one caveat to this that I want to talk about that I have heard, have not confirmed with the IRS, and they would never probably tell you anyways. But from what we have seen, we being me and the tax people that I work with, all the tax strategists that I work with, an S-Corp has a lower likelihood of being audited than a 1040 person does for two reasons. One, an S-Corp shows that you're a little bit more serious of a business. Two, there's less auditors. So if there's less auditors available to be able to audit them, then there's less time for them to go around, and they have to be able to make their money, right? It's a higher level of auditor who's making a little bit more money. So they're not going to come after you over some little things typically. But that doesn't mean, they're not going to flag you in the system. They have the great algorithm of all this data, and when they see things that don't quite work and give you a red flag, you may not get a full-fledged audit, but you'll get a letter that says, hey, prove to us this. Prove to us your marketing. Prove to us your travel. I think I've talked about that in past episodes of the podcast. So if you haven't listened to the other 20 episodes, please do that too. So what happens if the IRS says your wage wasn't reasonable? Well, they kick all of your distributions into the self-employment tax area. And now, instead of getting to move some to distributions and not pay the self-employment tax, you have to pay self-employment tax on all of it, plus the penalties and interest. So you lose that whole S-Corp deduction advantage. Okay, now let's talk about the QBI deduction real quick. This is probably the least understood deduction or opportunity for business owners. Here's the main point of it is an LLC and an S-Corp income can qualify, but S-Corp W-2 wages are not qualified business income because that's a wage. So whatever you pay yourself as a wage earner on an S-Corp, you have to pay the Social Security and Medicare. You also don't get to use that towards QBI. That's not going to be taken into account. Your distributions, you don't pay the payroll tax, but you do get the QBI deduction. So why wouldn't you just try to have as much in distribution as possible? Well, you would. But again, you've got to have that reasonable salary. So you've got to watch it. There's a fine balance there. You got to play a little bit of dance there with your salary to make sure that you're matching it where you should be. So guaranteed payments to partners as well is not considered QBI. High income contractors may face the wage and asset limits area where your salary, it saves you the payroll tax, but too much salary can shrink your QBI deduction. So like I said, it's kind of this fine art of balancing QBI deduction, payroll tax savings. You just got to work with it, and everybody's different. There is a website that you can go to called RC Reports, or Reasonable Compensation Reports, rcreports.com, I believe it is, that you can put in your information and you can actually come up with what a reasonable salary is. I would say that it's pretty conservative. So meaning you could probably be a little more, a little more conservative or a little more risky than what it's going to give you. The other thing I would say is be careful when it's asking you, like for example, I have a client who they did this report on themselves and they said they were a master at doing sprinkler repair. Well, they are a master at sprinkler repair, but to replace themselves, they probably wouldn't hire a master. They'd probably hire somebody who's just okay at it. So you don't necessarily have to pay yourself or pay a replacement $40 an hour to do sprinklers. So you just want, again, it's a balancing act. It's something that we take very seriously and we look at for our clients, and rather than just kind of throwing it up at the wall. So here's our compliance reality check real quick. In LLC, we have quarterly estimated payments for our taxes that are due every April, June, September, and January. It's easy to comply with these, right? It's easy to comply with LLC tax. We understand what we have to pay. We get a voucher at the end of the tax return, and we know what we've got to do. All profit, all income from the business gets applied to self-employment tax. With an S-Corp, here's the biggest challenge. We have payroll, and we have a corporate tax return, and we have K-1s. We've got to do more tracking, more admin, more discipline. So that's why I tell everybody, if you've got books that are messy and S-Corp doesn't save you money, it exposes you faster. What does that mean? An S-Corp is a bad idea for a contractor who has one net profit under $50,000 to $75,000. If you're making less than that in general, then you probably are not making enough money to be an S-Corp, because there are those additional admin responsibilities. Number one, you have to put yourself on payroll. So if you don't have any employees, now you have that added cost that you have to start doing payroll. Now, when I say you have to start doing payroll, that doesn't mean you have to have a regular paycheck every single week or every 2 weeks. It means that you have to pay payroll taxes. So at least quarterly, you need to report on a Form 941, on the federal Form 941, that you took a payroll, and you have to send in money for your Social Security and your Medicare. That's going to generate that W-2. So that's number one. Number two is you have a different tax return. You now have what's called an 1120S. That's the S-Corp tax return. Now, you don't have to pay any taxes on that at the federal level. At some states, you do. Like California has a minimum $800 S-Corp tax return. In Idaho, it's $20 to file it. And so, just it varies by state, but sticking to the federal, there's no charge for it. It's an informational return. You're going to get a K-1, which is kind of like a W-2 for your business. So you'll get a personal W-2, and then your business will get a W-2 called a K-1, and that all goes into your 1040, and that's going to determine the tax. But you have to file that return, and it's a lot more complicated. There's more information on it, so tax professionals charge quite a bit more for it. So while you can save money by not paying the Social Security Medicare tax, you are having to pay additional money for other admin stuff. So there's a balancing act there. Again, 50 grand, you're usually in the right area of saving money now to go after being an S-Corp. If your income is inconsistent, if you're way up and down, like, every business goes up and down, right? But if you're way up and down, like maybe you owe 6 months with no income, maybe you've only got a couple clients, you're not ready for it. Heavy reinvestment years. If you are looking at putting a lot of money into your business, probably not quite ready for an S-Corp. Or if you have horrible bookkeeping, if you don't know what kind of profit you're making, you're just going off of your bank balance, you're doing the bank balance bookkeeping that I talk about with Profit First, then you're probably not ready for an S-Corp. Let's get you cleaned up first. And if your cash flow is already tight, if you're not sure how you're going to make payroll every other week, if you're not sure how you're going to pay for the tax returns, then it's probably not a good time. You've got other budgetary things that you need to worry about. An S-Corp may not be the right time for you. So the IRS doesn't care what TikTok said that you were ready for an S-Corp. We want to make sure that you are in place, that you got everything in place, you're ready to go, and you can take this on, because it's very easy to become an S-Corp. You file that Form 2553, you mail it or you fax it, and you're an S-Corp. It's not as easy to back out of it, and they don't play. Those fines can be $230 per month per partner in those S-Corps. So the longer you go with not filing, the harder it is. And by the way, that tax return is due March 15th. It is due a month earlier than the regular tax return, because you have to file that tax return and get the K-1 to be able to file the personal tax return. So March 15th, those business entity tax returns are due. If you extend it to 6 months, if you do the extension, then it's due on September 15th. So March 15th, September 15th. All right, enough of going through the basics. Let's look at an actual example. So here's my case study that I have for you. His name is Craig's Landscape, and he had gross sales of $500,000. Maybe if I can get my pencil to work. There we go. He had gross sales of $500,000. He had materials of $250,000 right here. And then he had his wages. He took wages of $50,000 for himself. Now, with those wages, the business had to pay $3,825. That's the 7.65% of Social Security and Medicare that the business itself had to pay. On his W-2, you would see that Craig, he also paid $3,825. So he paid half of it, the business paid half of it. So the business gets to write that off. That's an expense for them, or a deduction that they get to put on there. So when you look at the tax return here, we're going to show we had other deductions, other costs, $100,000, whatever you want to call that. It doesn't really matter. For this example, we just put in that they had $100,000 of costs. The software, the trucks, the autos, whatever. So we had a total deductions of $153,825, meaning we had net income of $96,175. So when we look at this client's information, he's going to get a W-2 for the $50,000, and he's going to get a K-1 of $96,175. And we'll see that when we scroll down here. Here's our K-1. So this is like our business W-2. Here's Craig's Landscape. Here's the owner, Craig Smith. And we show here our income of $96,175. So this information here is going to flow through to our 1040. So now what we do is here's our 1040. Just follow me here. We've got our wages of $50,000. We've got, I was marking this up earlier and I didn't clean it. Here's our business income of $96,175, giving us a total income of $146,175. And we go in, here's our $146,175. We have a standard deduction. Well, I just made him single. So we have a standard deduction of $15,750. And then we can see here's our QBI of, make sure you can see it pretty well. Here's our QBI of $19,235. That's that qualified business income. Now, that's on only the balance or only the distribution that we took of $96,175 right here. This is what gets the QBI. So we're going to see in a minute here, it's only $19,235 here. If we were an LLC, it's going to be a little bit higher there. But that's because all of that income gets applied to it. So the entire business income gets applied to that. So we have a total of $34,985 gets deducted from our income. That's the standard deduction and then the qualified business income, giving us a total of I'm writing over so much that you can't even see the numbers. Giving us a total of $111,190. That's what our income is that we are going to get taxed on, or what you would hear as our taxable income. Now, according to the IRS effective tax rate, the tax on that is $19,533. So altogether, he paid $19,533 in taxes. Plus, really, if you look at it as well, to be fair, he also paid the $38.25. It's not on here. It's on the S-Corp tax return. but we got to add in the 3825 times 2, right? Because he did have to pay the Social Security Medicare tax. It doesn't show up there, but it's really $19,533 plus 3825 for the business plus 3825 personally. Hope that makes sense. Hope you followed that. Now let's go into a tax return where it's just him as a LLC. So you'll see here, there's no wages, right? We didn't have a W-2. Oh, goodness, come on. We didn't have a W-2. This is now as if we were just an LLC or a sole proprietor. No wages there. All we had was an earnings of $150,000. Now, you might be thinking, well, why is that more than what the S-Corp made? Only because of those taxes that were already paid. So we gave them a credit there. Now, here's our adjustment, and this is something that you don't get on the S-Corp. We have an adjustment here of $10,597. Why do we have that adjustment? Because we paid self-employment tax. When you're an S-Corp, you don't pay any self-employment tax, so you don't get any credit for it. But it's built right there in the tax return. If you have a business that you are paying self-employment tax on, you actually get a little bit of a credit right here of $10,597. So that's something that a lot of times those tax talk gurus don't mention. It's not exactly just the 15% because we do get a little bit of credit back. It's still going to be beneficial, but it's not exactly 15.3%. Okay, let's get back in here. So now we have a total of $139,403. Here's our QBI, or our standard deduction of $15,000, and then our QBI of $24,000. Remember, it was $19,000. Now it's $24,000. Why is it more? Because the QBI is on the whole amount, the whole $150,000. So it's a little different there. So our total taxable income is $98,322. But wait, we're not done yet because we still have, not only do we have the tax of the tax bracket for withholding of $16,000. So that's a little bit less, right? That was a little bit less than the last one. And I'm going to do a comparison here. So we're going to see it. I'll do a comparison. We'll be able to look exactly where it's at. But remember, that was less than on the S-Corp. So far, we're looking good. But right here, we have $21,000 that we have to pay. That's the self-employment tax. So we have to include that in there. So that equals $37,872. Altogether, for making $150,000, he paid $37,872. Now, let's go all the way down to our comparison. Here's the Schedule C. You can see where I put in same numbers. It's all the same there. Here's our QBI deduction. Well, first our self-employment tax. So here's the self-employment tax gets calculated out. Here's our QBI. And now here's our comparison. So on this comparison, it says 24 and 25. This is normally this is normally one of my favorite sheets actually that I show clients because it shows the difference between the years. And sometimes the tax will go up, but your effective tax rate actually went down. Well, in this case, what I'm doing is 24 really is just look at it as that's your S-Corp. And then 25 is when you were just an LLC 1040. So we had the wages of $50,000, business income of $96,175. And then you'll see right here, here's where I added back the other taxes of the $76.50. That's that $38.25 times 2. That's the Social Security and Medicare tax that he still had to pay. Instead of $21,000, it's $76.50. So bottom line is it worth it to be an S-Corp versus being a LLC sole proprietor? You can see we saved, in this case, Craig saved $10,689. And if you do the percentage on that, that means he saved about 39%. So it's not just simply 15%, because if we really take a look at it, it's $10,000, almost $11,000 he saved. Even with paying the Social Security, Medicare, and his wages, I included all of that. So is it worth it? In this case, yes, it was worth it. Now, Craig was ready to do it. He also, this is an example where he's making $150,000 a year. Had he done this earlier when he was making $50,000 or $75,000 or $100,000, he may have saved even more money, going all the way down. So the question is then, what do we do with that $10,000 savings? What do we do with almost 11 grand in savings? And what I would implore you to do is to look at your W-2 wages that you're putting in there. And that's when we start talking about different types of investments to be able to take that 11 grand and not just simply say, hey, I saved 11 grand, but how do we reinvest it into your business? Or how do we invest it into different retirement products so that you can really start to amplify the savings? It's great to save a little bit of taxes and to not have to pay the government. I'm all for that. But what I'm really for is figuring out how we can help you to reduce not only your tax liability, but to increase the savings and the retirement and really be able to change the generational wealth for your family. So I hope this video was helpful for you. If it was, and you've never had it quite broken down like this, hopefully it was not too it didn't hit you too hard. It wasn't mind numbing. But if it was something that, you said, I've not had my tax professional break it down for me like this, I've never quite understood it, I would love to meet with you. You can go to meetwithsavvy.com and schedule a discovery call, or just check us out on the web, savvytaxstrategies.com. And with that, I will see you next week where we break down another tax strategy.